Hello friends, today we're going to be talking about what a hard money loan is in real estate. Have you ever been in a situation where you found a great deal in real estate, but you don't qualify for a traditional loan, but you wanted to be able to take down that property? Well, you're in good company and you're not alone. And if you understood how hard money loans work, you might have been able to take advantage of that and never have to worry about that situation again. So traditionally in real estate, hard money loans get a bad rap. And a lot of times it really isn't justified, it's just misunderstood. So today I want to help you understand what a hard money loan is, how it's different than private money loans, who gives these loans, and help you understand the terms of a traditional hard money loan and really see if the juice is worth the squeeze. If you're ready, let's go. So what does a hard money loan mean? And how is it different than a bank loan? So traditionally, if you're not able to borrow from a banking institution, your only option, especially in real estate if you find a great deal, is a hard money loan. Now traditionally, a bank loan works like this. You go to the bank, they underwrite you as a lender, right? And that's a pretty tedious process. And they give you terms of a loan. And it's usually an interest rate that's par with what the current market is, but you're looking at a long-term payback schedule for the loan. It might be 10 years, 15, 20, 30, depending on what type of real estate you're buying. And there's that fixed interest rate. Sometimes it can be variable, but traditionally a fixed interest rate, and you're paying back interest as well as principal on the loan that you're borrowing from the bank. And over that period of time, you will have paid back the loan. Whereas a hard money loan, it's traditionally short term and the terms are quite different. On a hard money loan, the lender is looking for you to pay points up front. So what does that mean? Let's say you're borrowing $100,000 and they want anywhere between 2 to 4% points paid up front. So if it's a $100,000 loan, let's say they're asking for 4 points or 4 percentage points on $100,000 is $4,000. Now you can pay that up front, or you can bake that into the loan. So instead of owing them back $100,000, you're now gonna owe them $104,000. And the interest rate is traditionally a lot larger than what a bank's gonna give it to you for. So if a bank right now currently is at 8-9% interest rate, a hard money loan, you're looking between 10 to 18, sometimes 20%. And you might say, holy cow, that is a ton, right? And it is, but there are strategies where this makes sense, and I'll explain to you here in just a second. So now that we know what a hard money loan is, have you ever heard of a private money loan? Very similar to a hard money loan, but traditionally, a private money loan is with somebody that you know or that you have a relationship with. It could be a relative, it could be somebody else. Private money loans are very similar. There's usually points up front, and there's usually interest rates. Now, the interest rate is probably very similar to what a hard money loan is, anywhere between 10 to 20%. It really depends on how well you know this person. So obviously, if it's somebody you know and they have quite a bit of money or they're willing to loan money and they like you, it might be a little bit less. It's always good to have somebody like that you know, but there might be cases where you don't even have that connection or affiliation with somebody that's willing to do that for you. Another reason why the interest rate might vary on a hard money loan or a private money loan is how good your credit is. As I mentioned earlier, the banks underwrite you as an individual. Hard money lenders, private money lenders don't do that. The only reason they do the loan is because of the deal on the property. They are lending you money to get a piece of property because it's a good deal, right? The only reason they're willing to do that is it's a good deal. And the reason they're charging more is they don't have a lot of information about you as a lender, whereas banks spend 2-3 months really dive into the specifics of you as a lender to make sure that you can pay them back the money they're borrowing you. That's why there's more risk involved as a hard money lender or a private money lender versus a bank. So who gives these hard money loans? Where do you find a hard money lender? Now, I will tell you, any lender or any real estate agent that is worth their weight has in their back pocket somebody who's willing to do a hard money loan. It's also somebody who maybe is flush with cash. They have cash on hand, they've done a lot of different investments, and they're willing to maybe take a little bit more of a risk on this, but they still think of it like an investor. Because ultimately, if you default on the loan, guess who ends up with the property? They do. So when they give you money or they borrow you money, they are securing the money they're borrowing you with the property, unencumbered, right? That means that no other liens, no other encumberments are on the property. That property is solely secured by the money that they gave you. So if you found a piece of property worth $300,000 and you got it for $200,000, that person's gonna loan that money to you at a much higher interest rate for $200,000. And if you default, that property then is transferred over to them. So they truly are looking at it as an investment, either then making a good return on their money, because if you're paying them 15% on $200,000, They just made $30,000 that year on the property. And traditionally, another difference between a hard money loan versus a bank loan is traditionally with hard money, you're paying interest only, right? So if it's $200,000 loan, 15%, $30,000 annually you're paying, each month you're paying $2,500 to have that property secured with their money. And traditionally, they're short-term loans, usually for a year, 12 months, maybe 24 months, but renewed on a 12-month basis. And sometimes they might be a prepayment penalty. So if you buy that property, and if you were to sell it or pay the money back within a year, they might hit you with a penalty because they want that money, they want the interest rate for a full year. There are situations where this makes sense, but let me tell you one that didn't. So I was part of a charitable organization, and they had money from investors, to help with the charity. One of the parts of the charity was to invest money that they weren't using to have it grow, right? So they continued to do awesome things. And this was about in 2007 or 2008. So you probably know where this is going. There was a gentleman who had acquired a piece of property in Colorado, or he got it under contract, but he needed money to take down the property. So this charitable organization gave this gentleman a hard money loan, and it was fairly decent terms at the time, maybe 12%, nothing crazy, so he could take down the property. He took down the property, and guess what happened? The market tanked. The market tanked almost everywhere, right? And it was a large tract of land, and not much was happening on a large tract of land. He was looking to develop this property, and when the market crashed, the value of that, instead of being like 10 million, was now 5 million. And even though at the time it looked like it was worth that, and they had lent the gentleman X amount of dollars, what they had loaned him then became much less, and ultimately that charitable organization went out of business. It was kind of a sad story, but that's an example of when a hard money loan cannot go your way. So let's finish off with the biggest question of all. Why is it worth it? Why does this make sense? The real reason it's worth it is you found a screaming deal, right? You found a deal that there's enough meat on the bone that somebody is going to look at it and say, yes, I will loan this individual money because if they default, I'm going to pick up this property for a great steal. In the town I grew up in, I remember there was a home that came up for sale, it was about $120,000, and somebody picked it up for $90,000, and they needed a short-term loan. And traditionally it's a year, but they knew that they could turn around and sell this property. They secured the property with a hard money loan and paid some pretty good points on it. But ultimately, at the end of the day, they took it down for $90,000, probably ended up paying about $105,000, $110,000, and turned around and sold the property for $130,000 4 or 5 months later. So in that scenario, that made sense. So in order for this hard money loan to make sense for you as an investor, you really have to find the best deal out there. Finally, I'm going to tell you a story where I used a hard money loan. So as I mentioned to you earlier, one of my superpowers as a real estate investor was finding deals. I loved finding deals. Early on, I was looking for a large property, a ranch type property. And I had scoured everywhere from North Dakota, Montana, Wyoming, Idaho, Utah. I found a property in Idaho that was on the bank of a river, and it was an awesome property. Now, I went to the bank to get a loan. The bank was willing to loan a certain amount, and I'd got this property, it was about 1,000 acres. I got it for about $700,000. So in my mind, it was a steal, right? Now, the bank was only willing to loan $500,000 on the property, even though it was worth, even by an appraised value more than that, because I had bought it for $700,000, the bank was only willing to loan $500,000. Now, the gentleman I bought it from said, you know what, I will owner carry for you. I will sell or finance the other $200,000, but I'll only do it for 3 years. The cool thing about the property, it had income coming in from what's called the Conservation Reserve Program, meaning that if I left the property as is, didn't do anything to it, I didn't farm it, I didn't put cows on it, that the government was paying me $36,000 a year. That alone covered a majority of the payment I was making to the bank. But at the end of 3 years, I didn't have the money to come down and pay the gentleman off the balance that I owed him. At that time, I probably owed him about $125,000 because I'd made payments down every year based on his request. I knew I couldn't lose this property. So I went to an individual I knew, and he had hard money that he loaned me. He loaned me that money, and he was a super nice guy. I paid about 10% interest, which was still quite a bit, more than I could have paid at a bank, but I couldn't get a bank to loan that money. Ultimately, at the end of the day, I ended up selling that property for about twice what I paid for it. And it ended up making a lot of sense having that hard money loan. Now, I'd be interested to see your thoughts and your perception of hard money loans, or if you've ever had any experiences. So please comment below your thoughts on hard money loans. And as always, I've got a free gift for you. It's an Airbnb short-term rental calculator where you input all the data and it spits out whether it's a great deal or not. The link's below, aaronsfreetraining.com. Thanks for visiting. Have a great day.